There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice. Brought to you by TackleTrading.com.
Welcome out to episode 13 of the Trading Justice podcast. My name is Matt Justice with my co-host Tim Justice. Tim, as always, say hello.
Hello, everybody. Good to be here. Monday afternoon on July 21st. We're here with a specific topic in mind, right, Matt?
Well, I mean, honestly, we typically do have a specific topic of which one of us goes off on a tangent. But yes, we do have a topic in mind today. And
I can't promise that we won't do that again, by the way.
Well, I guarantee I will because of the topic that's going to be out there today. And it's something that, I think it's very, very important that everybody understands kind of what we're going to be discussing today, and where we're at in the traditional model, and what your options are from a trading perspective. Because I think most people, Tim, and agree or disagree, but I think most people out there, they think that trading is hard, and that they think that it's only for the big dogs on Wall Street and the Ivy guys and all of that. But I'm going to tell you right now, trading's for everybody. Investing's for everybody, whether you want to be an active trader like Tim or myself, or whether you just want to take control of your money long term and invest for yourself. It literally is for absolutely everybody. And there's no reason for these individuals out there in, obviously, 401ks to pay the trillions of dollars in fees that they do when they can just do it themselves and do much better anyways.
I'll tell you, trading can be as hard as you let it be. It doesn't have to be hard, and it shouldn't be hard. If you allow the emotions to kick in, or if you just ignore getting any training or education, it's going to feel overwhelming. I've known very educated people, Matt, that call me because they know, that this is a field that I work in, and they'll ask me, what do I do with my 401k? I've had friends who have PhDs and master's degrees and are working as professional people in different areas, running businesses, whatever it is. Don't understand the basics of investment. And I think that shows a financial illiteracy that's out there and prevalent in our country.
Well, I absolutely agree with it. We like to say that our nation is financially ignorant. And I certainly believe that to be a true case. And most times when you hear the word ignorant, people think a negative connotation. It just means lacks knowledge. That's really all it means. And those same PhD guys, I'm sure that we would be ignorant on many subjects that they are very, very wise on. So, yeah, we live in a financially illiterate nation. And, I don't even blame people. And the reason being is because we don't teach it anywhere. We don't teach it in our educational system. We don't teach people how to balance a budget, let alone, what an ETF is or an IRA is.
Yeah, that's right. And even when we do teach it, we teach it from old school thinking that's not current based on our economic system and the way that money is moved around the economy. Any kind of prevalent thinking that was there when pension funds were actually, considered stable, you need to update your information a little bit.
Seriously, Tim, I mean, you look at kind of the overall traditional retirement systems and we call them retirement models. You had a model out there that was dominant for decades, and it was called the pension model. And what the pension model was that you would work at a corporation or a company or whatever it is, and they would take care of you after you retired, right? That's what a pension was. And the problem with the pension model is it got really expensive because life expectancy increased. People were living older, and corporations, companies, and our system did not want to and could not handle the cost of the living after retirement because people lived way too long. They would retire at 60 years old, and instead of dying at 63, they were dying at 73, and that just put a lot of cost onto the economic system and the corporations as a whole. But
hold on a sec. Let me turn my phone off, Matt.
Lord Almighty.
Hey, I usually keep it on mute during the day. This is what we were talking about the other day on the podcast, is just, turn your technology off. Definitely when we're podcasting. That'll be rule number one is keep my phone off
Yes.
while we're on the podcast.
Yes, I would
It's a
say
good
that.
rule.
I'm not even going to cut that out. I'm
You were
gonna
in mid-thought there. It was
I
a great
was,
thought.
and I was in a good thought. I was talking about the retirement system and everything, and all of a sudden I got this, like, I don't even know, what was that? What was that music?
That was my new ringtone. That is one of the 12 available ringtones through T-Mobile. And I think it was like, I can't remember the name of it. It's like Cool Breeze or Cool something.
It's horrible.
Yeah.
It's horrible. Seriously. Anyways, back to the topic at hand. We were talking about the retirement model of the pensions, and simply put, it got too expensive. But what happened was Wall Street, they came out with a new model, and they designed it throughout the early 70s. The first publicly traded mutual fund was in 1976, and Vanguard and Bogle is the one who developed and created it. And what this model was supposed to be, and it was really the design of Wall Street, was it was supposed to be a self-contributing model, and it's basically an employee's savings account over the course of their work history of 40 years. And it was really quite ingenious of Wall Street to develop this, because you think about it, Wall Street all of a sudden made retirement completely on the onus of the individual instead of the corporation. And, you know, it just was now ingrained in our society. And a lot of people don't even realize it's their money. A lot of people with the 401k don't even realize that they're the ones that have been, you know, saving that money. You know, they think about, oh, the company is matching it. I'm putting in this, they're matching this. It's like, yeah, they're matching 3%. That's nothing. You know, and so it's interesting that people don't even understand kind of what a 401k is. But all it is a savings account that is invested in mutual funds. Now, Tim, just to kind of let people be aware of what a mutual fund is, talk about what mutual funds are.
Well, a mutual fund is where some kind of investment bank puts together a group of equities.
Mm-hmm.
And it could even be other investments. Funds can come in a lot of different forms and fashions. They can be foreign stocks. They can be large cap stocks in the U.S. They can be dividend-paying stocks. They can be bonds. They can be corporate bonds. They could be a mix of whatever. Generally, they're trying to, think of like a gift basket. Mm-hmm. Where you package all these different things in there, and then you tie cellophane around it and you wrap it with a bow, right?
Yeah.
A mutual fund is individual components in that gift basket, generally that represent one area of the market. Mm-hmm. And they're administered and run by banks and investment banks and those types of people on Wall Street. And because of that, something happens. And Matt, what is that thing that happens from the administration side of it?
Well, it's the fund manager, and the thing that you guys got to realize about mutual funds is that the actual institution that manages the fund, they don't trade the fund. Okay, they don't put their money in the fund. They only run the fund for you. And so they don't actually care if the fund goes up. They don't care if the fund goes down. Their role in this system is to simply sell you on the benefits of the fund. And they get paid what is called fees, okay, 401k fees to manage the fund. So if the market goes up, they make fees. If the market goes down, they make their fees. They don't care if the markets go up or down. They don't care if the fund goes up or down. The only thing they really care about is having the ability to sell you into a fund, so they want it to be, one of the better performing funds out there. But yeah, they have no risk out there. And you got to think about it for a second. When you have two entities in a transaction, one entity has all the money and all the risk. The other individual has no money and no risk, but individual two is the one that manages all the money. That doesn't seem like a win-win situation for the person with all the money, right, Tim?
No, and in fact, what's happened since its inception, which was a really good idea, as a transition from that pension model you were talking about, Wall Street has found their way, not just Wall Street, but bankers and middlemen and insurance agents and the guy next door who sells you, a home loan. Every financial advisor and financial type of institution, they find a way to sell you these mutual funds, and they found their fingers in the pot. And so a little bit here and a little bit there, and commission check to this guy, and annual salary to this fund manager and the middle manager, and to keep the heat on in the building. You just don't get
Wall
all the
Street,
returns.
Wall Street has a lot of cost out there, right? They got to heat the building, like you said. They got to keep the lights on. I actually have somebody on my team. Her name's Tracy, and she's a wonderful, wonderful, trader individual, and she actually trains the Wall Street fund managers. Okay, she's the gal that the institution hires to train the new reps. Follow me so far? Now, Tracy has been doing this for years and years and years now, and even she will attest that they don't actually teach the individuals to actually trade. Okay, these people are not there to trade; they are there to pass an exam, and that exam is called the Series 7, Series 3, 63, all those series exams, which are definitional basis, right? Okay, and once they pass the exam, they just run the fund, of which, that once again, their sole role is to sell you into the fund. It's a really nasty environment. And when you look at mutual funds, if mutual funds, I would be perfectly okay with them if a couple things happened, and I'm perfectly fine with paying somebody money if they show a net result that I couldn't do myself. Would you agree?
I agree with that wholeheartedly. I have no problem paying professionals to do a job.
Absolutely not.
It's something
Absolutely
we talk
not.
about all the time.
Well, and also, Tim, I have no problem with Wall Street being a bunch of salespeople. We need people to sell in our world.
I'm never gonna be negative about somebody who's just trying to run his business or make money.
Exactly.
So these Wall Street guys, it's nothing personal.
No, it's not. It's a systematic issue. It's not an individual.
Right.
It's not an individual matter. Well, there's two things. If the fund outperforms the market, I'm okay with that. The problem is 90% of mutual funds underperform the market. Now, when we talk about the market, we're talking about the major market indexes. And last year, the major market indexes, we're talking about the S&P 500, the Dow Jones, the Russell 2000, the NASDAQ. The Russell 2000 went up 37%. The NASDAQ went up 38%. The S&P 500 went up 30%, and the blue chip Dow index went up 26.5%. Now, 90% of mutual funds that people invested in went up less than those major market indexes. In fact, you have three basic types of mutual funds. You have what is called an aggressive fund, which is allocated in aggressive sectors, is basically what it is. Things like technology and industrial and consumer discretionary and energy, basic materials, those types of things. You would then have what is called a defensive or conservative fund, and those are allocated in like consumer staples and utilities and healthcare type scenarios, defensive type sectors. And then you have bond funds. Now, bond funds were the worst performing of the three major types of funds, and they did zero. Literally nothing last year, and that's to be understood. Fixed income strategies like bonds, where were interest rates last year, and they never changed, And so the people who were in bonds last year, they made nothing. And you hear people who are in bond funds, and as I travel, I get this all the time. You know what they say, Tim? When I ask them how they perform, and they say zero, what do you think they say? What do you think these consumers that I talk to on a weekly basis say about doing nothing in over a year?
Well, at least I didn't lose.
That's
money.
exactly what they say every single time, without fail. It's like, well, at least I didn't lose, and I'm like, oh my goodness, I'm so sorry. I'm sad. My heart cries right now. Then you had conservative funds last year that went up on average about, some 6, 8, 10%. Most of them under 10%. And whenever you ask somebody, hey, is an 8% gain yearly? Is that good? Everybody's like, oh yeah, that's fantastic. And you know what? Why they say that, Tim? They say that because they've been sold on the fact that the market historically has went up 7.5, 8%. So if they go up 8% a year, they're like, yeah, I'm on average. Well, what they don't realize is there's like 4 major markets in the last 100 years that have done this. The rest of the time, it's either went sideways for a decade and a half or down. And so it's like, okay, are you in the right time to do this? And so, yeah, if you look at it for the last 100, 150 years, yeah, you've averaged 8%, but you haven't done that over the last 15 years. Okay, you haven't. And so, then I tell them, I say, hey, listen, well, what about 30%? Would you rather done 30%? Oh yeah, that would have been fantastic. And then I asked the aggressive funds, and I said that the aggressive funds, they went up on average about 22%. And everybody's just so ecstatic at 22%. And I'm like, yeah, that's an amazing return, right? And they're like, oh, yeah, that's awesome. And I said, well, listen, let's say you take your 401k. You convert it to a self-directed IRA, which is an individual retirement account, and you take that same money. Let's say it's $100,000 in a 401k and $100,000 in the IRA. So you have the consumer one who is invested in 401ks. They have $100,000. Last year, we'll say they went up 15%. All right?
Let's back up a step here, Matt. We assumed, we made an assumption right there. I'm sure there are some people out there thinking, well, can I even do that? Is that within the rules of our financial system, that if somebody's in a 401k, can they convert to an IRA?
The great question, and yeah, we did make an assumption because sometimes we do that, right? Well, I'll just tell you this. I asked my group of students in Houston how difficult that is, because we have a tendency to make things really, really difficult when we don't know what it is, right? We just have a tendency to throw it out there. Well, I had about 50 people in my Houston event this past weekend, and I asked the crowd, how many of you have converted a 401k to an IRA? And to answer your question, yes, it is absolutely perfectly fine. You do not pay a tax to convert to an IRA. You only pay the tax penalty if you actually pull the money out, which even in that, some people will pull the money out of their 401k, put it into an individual account, which we'll talk about here in just a moment. But I asked the group, I said, of those that have a 401k, how many of you have converted to an IRA? And there was about 3 of them. And I asked them the question. I said, how difficult was it on a scale of 1 to 10 to do that? 1 being the easiest thing in the world, 10 being the most difficult. And they said, oh my, it's 1. It's a phone call. It's a click of a button. The phone call takes 5 minutes. It's very, very easy. The hardest thing that people have is making the decision to actually do it. After you made the decision, it's really, really, really easy. It's just making the decision. So yes, converting a 401k into an IRA to where you have much more control over your money, where you can make many more, flexible type trades and investments. That is something that a lot of people look to do because they just get more control and they get more flexibility. But back to the example real quick. So you have the consumer with $100,000. Let's say they go up 15% last year. How much money did they make last year?
15 grand.
15 grand, okay? Now, you have another individual with $100,000 last year. And they, came to one of our trainings, right? And they heard us talk, or on this podcast, for example, and they heard us talk about converting from a 401k into an IRA and how you can invest in what's called an ETF. And they take their money and they invest in the spiders. And for those of you who do not know what the spiders are, for every major market index, you have market-related ETFs. For example, in the S&P 500, Tim, what is the ETF?
S&P 500 is SPY.
It's called the spiders. For the NASDAQ, what is it?
QQQ.
It's called the Qs. For the Dow Jones.
DIA.
So you have these major market indexes that you can actually buy through an ETF that track 1-to-1 with the market. So if the market goes up 1, you go up 1. If the market goes down 1, you go down 1. And what Warren Buffett said is he gave an interview in December of 2013. And he said, if you had invested in a very low-cost index fund, and what he was referring to was the spiders, the S&P 500 ETF. If you had invested in a very low-cost index fund, you would have done better than 90% of the investors. And that's what it really is about. It's not hard. And so let's say that individual has an IRA, he puts it into the spiders, which tracks the S&P 500, that goes up 30% last year. How much did the investor make simply by converting his 401k into an IRA?
An extra 15 grand. So the $30,000.
$30,000, right? Yeah. So he makes an extra $15,000 there. Now, we've already talked about the difficulty of converting a 401k into an IRA, correct? It's the easiest thing in the world. Tim, from a trading perspective, how difficult is it to buy the spiders?
Well, It's easy. I was going to try to find something sarcastic or funny in there, like if I
it's a
have
click of a
arthritis
button,
in my
right?
finger, right? Yeah, no, it's easy. As long as you can use your mouse or make a phone call to your broker, you can convert it, and you can buy.
And so when we're talking about some of, and guys, there are very, very difficult things in trading, no doubt about it. When you get into options and you get into volatility and you get into strategies and you get into, economic impacts and whatnot, there's some difficult things in trading. Trading is not one of them. Trading and placing trades is the simplest thing you can possibly imagine. And so when it comes to the things that we think are difficult, it's probably just because you haven't done it yet and you've never, really thought about it. But, when I look at something like that and it's as easy as a click of a button to perform with the marketplace, I got to ask myself, what in the world is the funds doing when they can't do this? Why is it that these conservative funds go up 8% and even aggressive funds underperform, significantly by like 30%? Why? Why do you think they underperform?
Well, I'll tell you, I think there's a lot of things, but simply the number one thing is they are much more conservative because they get paid their bonuses. They keep their money in cash sometimes, Matt. Mm-hmm. And one of the reasons they do, and they're slow to the trigger, because they receive their bonus checks if they're running the money as long as the fund is profitable. And so they're very much a day late a lot of times, mm-hmm. which isn't always a good thing. That doesn't mean they're being more conservative. They're going to lose less if the market's down. No, they're just slow. They're relying on their own motivation to collect commission checks and charge fees and keep their job and hit their bonuses. It's a corrupt system from the get. Yeah. And it's not corrupt on human nature. It's just what it is.
It was designed in 1976. It was designed to be ineffective, an inefficient model. And what I mean by that is that it's never going to make the consumers rich.
No, it's not. And it may be a better system than the pension fund, because the old pension funds
were broke, man.
Yeah.
Pensions were broke.
It was an improvement on that, I think.
Well, and also I want to say this because Bogle is not a bad guy. He's an awesome guy. Bogle was the founder of Vanguard. He was the father of this system, and he, back in 1976, I think what he created was something that at the time in 1976 was something very, very good. For what they had at the time. The problem with it is what has happened to the market today. The market has evolved today. It's not the same market as it was in 1976. We didn't have the ETFs like the spiders where you could easily just buy. We didn't have easy access to online brokers that we could just easily trade. And so it's just different from a technological standpoint, from a market standpoint. The model, I do not think it was created to rip people off. I do not think that. But I think because of what has happened with the evolving market and technology, the market, the traditional retirement account, the 401k, it's completely dead today, Tim. I mean, it's not a model that works. And even Bogle has came out and said that. Bogle wrote a book called The Little Book of Common Sense Investing in 2007, where he basically stated that this is a corrupt system. The father of Vanguard said it's a corrupt system because of what has happened today. And everybody knows, it's as easy as putting your money in the spiders or the Qs or IWM or the diamonds to perform with the market average. In fact, some of these funds out there, Tim, and there's thousands and thousands of them, some of these funds, guess what they invest in? The spiders.
Yeah,
the
a lot
Qs,
of them do,
and they still underperform.
I know.
Because
there's
that's
all
amazing.
those fees involved, and there's all kinds of different middlemen involved. I mean, here's the thing. Anybody who owns a business out there, would you rather get your product that you have to deliver or use, whether you lay cement for a living or whether you sell you have a boutique shop or anything? Mm-hmm. Would you rather get it directly from the manufacturer or have it go through 5 different middlemen?
Oh, I love middlemen.
Right, of course we do. No, I mean, obviously you'd rather get it direct from the manufacturer.
Well, and that's what we're talking about too, is that's what an IRA allows you to do. Go direct to the market to cut out the middleman, because when you look at fees, the broker, not the broker, but the institution who manages the fees, they'll say, oh, you only pay 1 to 3%. Well, they don't understand how much that truly is. When you look at the subprime market meltdown in 2008 coming into the end of 2009, consumers lost an estimated somewhere around $5 trillion. I've seen it as low as $3 trillion. I've seen it as high as $10 trillion, that came out of traditional 401ks. And it crushed people. And it's taken 5 years for them just to get back to break even. But you look at it and you ask people and they're like, oh, I cannot go through that again. I cannot lose that much again. I can't just do this again. And you ask them, I said, well, how much have you paid in fees over the last 5 years? And Tim, we have, as a consumer society, we have paid over $5 trillion in fees since 2009.
Incredible.
I mean, we lost $5 trillion in the bear market, and nobody can handle that again. But then we lose another $5 trillion in fees, and we don't even ask ourselves why. Because you know what? You don't notice it because it happens over time. Right. You notice the bear market because it happens in a year, and a lot of the movement actually happened over like a 3, 4, 5 month period. But you don't notice the fees because it's like a a slow leak in your tire. It's a gut shot, man. It's a gut shot. Bleed out.
Like the tire in your car where you come out every day and it's just kind of flat. About every 2-3 days, you got to go fill it up again. Well, those are your deposits back into your 401k.
Yeah, exactly. Have you ever seen that? I'm sure you have. You've seen the movie Office Space, right?
Love it.
Okay, what was their harebrained scheme to get out of the rat race and whatnot? What did they do?
Just a fraction of a fraction of a
fraction
penny.
of a fraction of a penny. And they were going to get, this was going to take a long time to do it. And then the next day, the company's missing $238,000, right? And when the company's missing $238,000, you have a tendency to ask where that money is, right? Well, the people who created that harebrained scheme, and they're like, oh, they just didn't understand how many transactions there are out there. And that's the Paul Rudd's in that. Is it Paul Rudd in that? No.
Yes, he is.
Yeah, Paul Rudd's in that. And then what's the main?
Jennifer Aniston.
Jennifer Aniston's in it. And what's Paul Rudd and the other couple guys? That's consumer America, guys. They just don't understand how many transactions are actually adding up to the trillions of dollars in fees that Wall Street charges on a yearly basis, on an annual basis. And the thing about it is, you don't have to participate in that asinine system any longer because there's better ways. You can convert to an IRA. You can control your money. And it's as simple as a click of a button to outperform 90% of investors out there. I was in this past weekend in one of my meetings, and I was talking to this guy. He was thinking about mentoring, and I was looking at kind of where his money's allocated. And Tim, I swear to heaven, I was looking at his portfolio. Guess how many different mutual funds he had?
I'm going to throw out 20.
300.
Holy cow.
300. How in the world do you manage 300 positions?
Oh.
How do you do that? And he was like, oh yeah, some are doing good. Some I bought because of this. Some I did because I heard it in the news. And I'm like, you're gonna get slaughtered. I just felt so bad for him. He's an older gentleman, and I just felt so bad for him because he thinks he has a lot of money right now. He was close to $1 million he had, but if he loses 50-60% in the next one, does he have enough money to go on the next 15-20 years to him? No, he doesn't. And that's a sad reality, and that's an impact that a lot of people have out there. And that's the problem. 401ks, you only make money in one direction in the market, and that's up. And even when the markets go up, you go up less than the market. And then when the markets go sideways, guess what? The market doesn't lose, but you do. And then when the markets go down, you lose more than the market does. And when it's as easy as simply a click of a button and a phone call to get away from that system. So why do you think people don't do it?
Well, excuse me, I've had a cough this week. But the first thing, I was thinking about what you said there for a second. And do we really need to feel bad for somebody who's been in the financial system for 50 or 60 years and still is a victim of the system? I'm going to throw that out there and be blunt about it for a second. Or should we just simply try to educate that person?
Yeah, you got to try to educate him. I think you got to try to educate him.
I mean, I understand what you're saying, but I'm not sure I have a lot of sympathy because I
No.
can't relate to that. I mean, I started trading when I was 25 and thinking about money different from a young age. And maybe I had a different upbringing and different experiences, and I'm trying to share that with people. And believe me, I'm not trying to be like, well, you should have known better. But at some point, doesn't somebody have to take responsibility for
It's
their
our
own?
money, Tim. It's our money. We have a responsibility. So yes, I do feel bad for consumer America because we never have taught them in our system, in our models, in our education. But at the same time, we've given a lot of our control away. We became a complacent society, and we have a tendency to bitch and moan about Wall Street and politicians and all this, but we really don't do anything about it. And then when you give somebody an opportunity to really educate themselves, they don't do it because they're like, oh, I don't have enough time, I don't have enough money, or whatever the case might be. You hear all the different excuses in the world. So, I do feel bad to a certain extent. But you know what, Tim? You think about it from our trader's perspective.
Mm-hmm.
When you look at all the different market participants out there, you have the hedge funds, the institutional traders, you have the Goldman Sachs, the Bank of America, the JP Morgan, those type guys. You have, central banks now, sadly. Thank you, QE and Van Bernanke. You also have, consumer America and the professional traders. Okay, out of all those market participants, consumers are the most predictable, and thus they are constantly taken advantage of. Constantly. We know exactly what consumers do when they have money. We know exactly what they do when they get scared. And because of that, they just get taken advantage of by the Wall Street institutional trading firms. And I don't think that is sad at all. Because, you think about 2007, Tim, when we were talking subprime market crash, and consumer America, who'd they blame? They blamed the banks. They blamed Wall Street. But who borrowed the damn loan in the first place when they didn't have anything to put down? Who got the 18% interest rate, right? Who went out there and pulled out all of their money refinancing because they couldn't live without the boat they wanted to? I don't blame Wall Street for that. And consumers have to take on some responsibility. And they're doing the same thing. In the next crash, they're going to lose even more money than they did in 2008. And you know what? They're going to go occupy Wall Street again. And I'm going to laugh.
Well, this is funny. I hope that anybody who listens to our podcast over time, I want to make a point right here that is a little off topic, but completely on topic if you'll follow me. People accuse us of being liberal sometimes, Matt, but yet how much more conservative can you get than the rant you just had, which I love, and I believe in 100%. You are responsible for your own actions.
People accuse us for being liberal because we're not traditional conservatives.
Right.
We're not we're different, but I will say we're libertarian is what we are. We don't like big government. We don't like government interfering with our personal lives. We think the family can control the family. We're just libertarian, and from that perspective, we have a responsibility to manage our own money. We have a responsibility. We're the CEO of our family. And as that, I have a right and a responsibility to make money in regards to what the market does. And so, yeah, I mean, it's very conservative. And we have many, many, many conservative, ideologies and whatnot. So, when people, accuse me of being liberal just because, I don't hate Obama, I don't care. If they want to go on Facebook and just complain about that and go, talk about how he should be impeached, that's fine with me. I don't give a shit.
I got a funny story. I had a Republican friend, pretty conservative guy in my office a couple years ago, and we're driving down State Street here in Utah, and he says, you keep saying you're liberal. What does that mean? Because I guess I say that sometimes because I'm not the traditional Republican from Utah.
Yeah.
And he says,
thank goodness, by the way.
Right. Yeah.
Come to Utah, you'll find out what we mean by that. Come to Emory County for a couple days.
Right.
Yeah.
Anyways, as you keep saying you're liberal, what does that mean? He's like, I just want to stay out of people's business. I don't care if they smoke pot or get gay married.
No, doesn't bother us.
Oh yeah, I don't care about that either. Like, I think that, being in Utah or even in a homogenous area, you think you might be very radically different than somebody else who might label themselves conservative or Republican. Something I believe in. There's a lot of like-mindedness in this world.
I'll tell you right now, if you actually broke it down to our political leanings, you would probably label us conservative. I mean, and probably we're much more conservative to what a true conservative truly is than almost everybody we know that we grew up with or whatever the case might be. We just don't care from a social standpoint, we don't care what people do with their own lives.
I don't want to go all Harvard philosophy school on you, but it's called neoliberalism. John Rawls, John Locke, Adam or Hobbes,
Thomas Hobbes.
Yeah, Thomas Hobbes. Anyway, we'll get to that another time.
That would be a great podcast right there.
Trading Justice podcast.
Boom,
with your
drop.
hosts, Matt Justice and Tim Justice.
Main host.
You can find us on iTunes. You can find us on the Trading Justice website. If you do like our podcast, please leave us a review on iTunes. 5 stars is always welcome. That's a big high five when we see you, because we love putting it out there and we want other people to find us as well. Matt, there's one other component that I wanted to transition towards in regards to this whole conversation. When you move from a 401k to an IRA, and if you have the training and the knowledge on how to use these tools, you have access to a few other products that you don't have in a 401k. What are some of the major ones that can help people protect their money?
A couple things. Number one, in a 401k, let's just talk about the regulations first. You are very, very regulated in a 401k. And some 401ks much more than others, like government TSPs and whatnot, very regulated in those types of accounts. You really only can buy in a 401k. You can just buy, mutual funds, some stock and whatnot. In an IRA, you get more flexibility, which means you have a higher trading authority level, so you can do like covered calls, and you can do that in a 401k as well. But you can do like cash secure naked puts. You can do strategies that are some of the most conservative, highest probability strategies in the entire market, called credit spreads in an IRA. And you can buy put options, Tim, and you can short the market, Tim. And that's, I think, is the biggest difference in an IRA versus a 401k, is you can make money in multiple market conditions, not just bullish. And that's very important, guys, because there is a cycle that we've been seeing over the last 18, 20 years. And the market typically will go up 5.5 years. It will level off, then go down 2 years. And because of that market cycle, we've called it the lost generation of wealth, because most consumer America doesn't have much more money today than they did, say, in 2000. And that's because of the market cycle. And to break that market cycle, you first have to not lose money in the next bear market, or better yet, you have to make money. So you can't do that in a 401k. You have to do that in an IRA or an individual account. And let's specifically talk about a couple different things here. And in terms of making money in a bear market in an IRA, there's two main primary things that you can do. Either one, you can do what we call is shorting the stock or shorting the market. Now, shorting, Tim, for the layman out there, how would you describe shorting to the just average investor?
Well, the first thing I would tell you is you don't have to know why they let you do it. So let's start there.
No, you don't need to know how the engine is built to stick your keys in the car.
No. And the analogy I use, Matt, all shorting is when you sell something you don't own. Let's start with the definition. You sell something that you did not own to begin with.
Okay.
Now, why they let you do it, don't worry about that. I use the analogy of the football game. America's true sport. May not be America's pastime like baseball, but it is the sport. Everybody knows it. Look at the numbers,
it's
TV ratings, money. Everybody loves football. Do we need to wonder why the original creators of football let the defense pick up a fumble or pick off an interception, take it into the other end zone, and we award them 6 points? No, they just do.
Definitely do not.
Okay, pick six, fumble Ruski, into the end zone, touchdown, the defense can score. Just let the rules of the game be the rules of the game. In markets,
I love that analogy. I love that analogy because when we grow up with something like this, we just accept it, right? We just accept it. Like, we grew up playing sports, playing football. We never really questioned why we couldn't after we caught the ball, we couldn't throw another forward pass. We never really question. We never ask, well, why? Yep. Why do they not allow me to do that? We never question why, we were allowed to pitch the ball back and then throw it. Well, why can I do that, but I can't do it the other way? We just accept it as a rule. So I love that analogy. Ladies and gentlemen, we can short stock. We can sell things we do not own. The market just lets us do it.
I would love to do a poll, and maybe, I love statistics. I'm a nerd like that. Mm-hmm. I would love to do a poll of just random cross-section of people, adult age, who have investments, either a 401k, stock, just some form of investment.
Yeah.
Ever made at least one trade or one investment. And to know how many people have ever sold a stock short.
I'll give you the numbers right now. I'll give them right now. 5%.
5% of traders or investors. It's incredible.
Yeah.
Now, here's something that anybody who's been around the game or the business believes, either intuitively or they've seen it in action, is that it's not 5% of Wall Street that knows how to do this. It's more like all of them. And it's not even that they want to avoid doing it. In fact, it's part of their system. Mm-hmm. You run stocks up, and then you crash them back down.
And then you crash them back down. And you make money on both sides of it. I want to give another analogy real quick. First of all, for every transaction in the market, ladies and gentlemen, you have a buyer and a seller. When you buy a stock, you simply act as the buyer first. When you close that trade, you act as the seller. When you short a stock, you are borrowing the stock from the broker, selling it to somebody else. So you are simply behaving as the seller first, and to close the transaction, you then act as the buyer. Now, the analogy I give to kind of help people understand it, Tim, is what banks do. Tim, when you put your money in a bank, okay, what does the bank do with your money?
Well, they lend it back out.
Okay, they lend it back out. So can you also say that they sell it to somebody else?
Yeah, they sure do.
Okay, now, so you put your money in a bank, they sell it to somebody else in the form of a loan. Now, if you went back to the bank tomorrow to get $100 out, what would the bank do?
If I wanted my $100 back, they'd give me $100.
Now, would they give you the exact same $100 you gave them?
Nope, that money's already moved.
Exactly, and that's the same thing that's happening in shorting stocks. When you short a stock, you're acting like the bank. That's it. You're borrowing the stock, you're selling it to somebody else, and when you close the trade by buying it back, you're buying back somebody else's stock. It's the exact same thing, and it's prevalent in our economic system. And guess how many people have checking and savings accounts? Everybody. Everybody participates in the art of shorting. They just don't realize it. And the same thing can be said, like if you ever purchase something from an infomercial. Guess what? The infomercial doesn't own the product. They take your money, they go buy it from the manufacturer, deliver it to you at a later date. It's the same thing as shorting stock. And so when you put it into the proper context, whether you're talking about questioning the rules of the game from the football analogy, or you're looking at it from a banking standpoint or the infomercial standpoint, realize it happens all the time. And if you're going to be a successful investor, whether you're in the 401k or an IRA or an individual account, you have to have the mindset to be able to get out there and short stock so that you can make money in the bear market.
And there's an alternative to shorting stock, which is maybe going to be the topic of one of these podcasts. And guys, we've asked this before, but if you have requests for topics or trade ideas or anything you want us to talk about, we're pretty much an open door, here at the Justice Crew. But put options, Matt.
Okay.
Short selling is critical, but one thing about an IRA that they allow you to do that you cannot do in a 401k is to purchase a put option against your capital, which, by the way, guys, I'll just try to explain this as simple as I can. Keep it simple, right?
Yeah.
It's just insurance. That's it.
That's it.
It's like having a whole house insurance.
Well, it's true. Everybody has house insurance. Everybody has car insurance. Everybody understands the way insurance works, and that's the only thing a put option. It's insurance. When you buy a put option, you make money as it goes down, and as a form of insuring your stock or just wanting to make money as the market goes down. When you sell the put option, you're acting like Allstate.
Yeah, and there's a lot to them when you get into the little strategies, and everybody can learn how to do them. But for a new investor, somebody who's just making this transition from where somebody else is taking your money through fees in the traditional model, and you're trying to get control of yourself, these little transitions are important. Just, converting to an IRA, getting control of your capital, learning how to pick your own funds through the forms of ETFs, which are just like the mutual funds,
except they trade during the day.
Fees.
You avoid the fees, and they trade during the day. You can buy and sell them during the day. You can trade options on ETFs. Instead of buying the ETF, you can leverage yourself by buying a call option on the ETF. So there's infinite amount of possibilities you can do that are more effective, more efficient, and give you greater control in an IRA than you do in a 401k. And also, and like you said, you also don't participate in the $1 trillion of fees consumers pay Wall Street every year.
And Matt, the one thing I always take some notes before our podcast, and the one thing I put down to make sure that I say is that, guys, savvy investors and traders learn these techniques.
Absolutely. And
you weren't taught traditionally through school, but there's no reason why you can't learn them.
No, I agree with that 100%. And guys, a lot of the things that we've talked about on today's podcast, they're not difficult. They're just not. It's not difficult to, convert to an IRA. It's a phone call. It's not difficult to put your money in the spiders and match the market average. That's easy. That's the easiest thing in the world from a trading perspective. It's not difficult to learn how to short stock. You have to put some time in. You have to dedicate yourself like you do to dedicate yourself to anything else. But at the same time, it's actually a fairly simple strategy. And you buy a stock, you make money when it goes up. You short a stock, you make money when it goes down. And if you want to have the control that you desire, if you want to not go through what you did in 2008, 2009, and you want to significantly alter the genetic makeup of your financial life, you have a massive opportunity on the downside of the market over the next couple of years.
You guys are listening to our Trading Justice podcast, and I'll tell you, tomorrow night, Matt, we have another podcast planned, and what is on the agenda?
Well, we got 2 podcasts tomorrow, actually. Podcast during the day, we're going to bring on a real estate investor, Tim, and I'm looking forward to that a ton. How much do you know about investing in real estate, by the way?
I've been around successful real estate people, and I'm always poking in, questions. I'm not shy. When I meet somebody successful...
you try to get it, right? You try to get the knowledge.
I'm just not shy about it. I try not to be, annoying about it, appropriate time, place, but... when there's a moment where there's an opening, I'm taking it, right?
Oh, absolutely.
Shooting the gap.
Jeremy Reese, a real estate investor, motivational speaker for Rich Dad Education, and been just an investor in real estate for a long time now. He's going to come on, join us on the podcast. We're going to do a real estate podcast, kind of talking about the strategies that you can start applying in real estate. And by the way, Tim, did you know you can invest in real estate in your IRA?
Yes, I did know that.
Oh, wow.
Yes, I did know that. And, the extent of any real estate investment that you and I have done, Matt, have been through our father, the way he's done it traditionally.
Build a house, sell a house.
Yeah,
right?
Pretty much.
Build
a house on land you own and sell it. Right?
That's the extent of our real estate. We know how to put a hammer to a nail, and so that's. But I'm looking forward to that one. We've been planning it for the last couple of weeks. Jeremy's busy, we're busy, so it's been kind of hard from a scheduling standpoint. But Jeremy's going to be joining us to talk about real estate. And then tomorrow night, we got a really good one planned, and that has to do with preparing people for the absolute beast of economic activity over the next few days, starting with the GDP report Wednesday morning, going into the Fed announcement Wednesday afternoon, and then finishing up on Friday with the unemployment rate as well as the manufacturing report. So we're going to do an economic discussion on economic reports, why they're important, how we use them. Kind of, I'm sure it'll be dominated by the Fed, and we'll try to bring on maybe Noah or Gino from Tackle Trading to see what they can do from helping us out, preparing all the podcast listeners for those events. They're amazing events. They're trading environments that are amazing in and of their own right, but you got to be familiar with them because they are the number one drivers of the market.
It's always exciting to be here with you, Matt. Any last thoughts from you in terms of advice for these guys?
I guess my advice would be, from a 401k standpoint, I guess the thing that I just am most upset about, it's the way they're started. And they're started when we go into our first career, our first job, if it is a full-time job, and we're going to the HR, and the HR individual, they basically give us a packet, and they call it our retirement. And we don't have the knowledge basis to, even make a decision over it at that point. We just choose one, right? And
Pretty
typically
much.
It's like pick a dart. Do you want aggressive? Well, you're younger. You can be aggressive. If you're older, you probably want more conservative. It's just a blueprint. And
do you know the Burger King or burger chain In-N-Out Burger?
Yeah, In-N-Out's great.
Delicious, obviously.
Yeah.
Anybody who's been on the West Coast, Vegas,
In-N-Out's
California,
great, man.
Utah, Arizona, In-N-Out's amazing. Well, In-N-Out has a very simple menu. They are famous for their simplicity in their menu.
Yes.
You get a single, you get a double, you can get fries, you can get a shake.
Yep, that's it right there.
Pretty much it.
Yeah.
There's lemonade.
Yeah.
Right? Do you think it's harder to be an In-N-Out fry cook or a HR 401k representative?
Oh, wow. Probably the fry.
Fry cook?
Well,
because you got that whole secret menu thing.
yeah, it's
the
right there,
style
right?
and
Yeah,
run
it's
it
right
through
there.
the garden,
Well,
right?
honestly, the HR individuals, they don't know any better either.
I'm not trying to run them down. But I'm just...
I am. I'm going to run them down right now. It's a travesty that's what we do in our society, that we give somebody a pack and we call it your retirement, and then they're shocked and amazed that it doesn't work out as planned. Really? That's what all you have to do? Well, here's the thing, guys. You don't have to participate in that. You don't have to accept it. Remember, it is your savings account. And if you simply say no and put your money in an individual account, say a broker, you put your money in an individual account with a broker, say it's 10% of your paycheck, you have so much greater control over that money, and you can do so much better from an ROI standpoint. You can still put your money in IRAs and take tax advantages there as well. So there's a lot of ways and a lot of flexibility you can do if you first choose that you want to be financially literate, number one, and that you want to control your money, number two, and you want to make money as the market goes down, number three. And if the answer to all of those is yes, yes, and yes, then you got to go out there and educate yourself and find people to help you along the ways.
My final thought here, and before I do, you got my song to take us out?
I do. I got it.
All right.
I got it. It's
excited
ready.
about this one.
I'm fired up.
But my final thought here, guys, is that don't worry about what you weren't taught 10 years ago or in college. We sit and talk about that.
You don't have the hot tub time machine, man.
But all you can do is move forward from today. And
right.
if that first step is just reading into your 401k, looking into the IRA, call your tax guy, whoever, call somebody you trust and say, hey, what do you know about this? What's the difference?
In fact, here's the thing we're going to do, because you just got me looking at this. I want everybody to pull up your mutual funds, see what you did in your mutual funds last year. Okay? Call your broker, your fund manager, and ask why you underperformed the S&P 500 last year. See what they say. Everybody.
Yeah.
Put the pressure on. Let's run them down.
I would love to hear those recordings on YouTube.
Oh, man. Yes. And if you want to record the conversation and send it to us, we will play it on the podcast. We will delete any of the names. But Tim, it would be funny, okay? They would say, well, we're diversified and we're just trying to protect your future, and let me get back to you because I'm going to contact my boss and see what's going on here, see what we can do to help you out there. It's a joke. It's an utter joke. It's a systematic problem. It's a joke. And I know we've been kind about some of it, mean about others, but the simple reality is you can do better with the click of a button, guys. And, the last thing I'll say on that, because I mentioned the word diversification, the traditionalists out there will just preach diversify, 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 diversify. Susie Orman will go, 3 things you need to be good at. Well, 2 things you need to be good at to be successful is you need to diversify, number 1, and you need to dollar cost average, number 2. And both of those 2 things are 2 of the most harmful mentalities you can have as a trader or investor, and I'll tell you why. Diversification, in Warren Buffett's opinion, is nothing but a protection against ignorance, and it makes absolutely little sense if you even have just a tiny bit of knowledge in terms of investing in the spiders, for example. That's Warren Buffett that said that, and I absolutely 100% agree. Diversification is an absolute protection against ignorance because you don't understand the word correlation. Our markets are correlated, which means when they go down, it all goes down. When it goes up, they all have a tendency to base or go up. It is a correlation of markets. Diversification makes little sense if you actually know what you're doing. And dollar cost averaging might be the dumbest thing I've ever heard of, because the reality is this. Dollar cost averaging, for those of you who don't know what you're doing, or don't understand what it means if you buy 100 shares at a $100 company, okay, you have a $100 average cost. If the company goes down to $90 and you buy another 100 shares, Tim, what's your average cost?
So you bought originally at 100, then down at 90?
Yep.
Okay, well, your average cost is what, 95?
95. Well, What's the problem with that? You still lost money.
You're still at 90.
Yeah, you still lost money, which means it needs to go up 5 points for you to break even. Well, the problem is it's going down. What's more likely it's going to go down to 85 and you're going to lose more money. Well, instead of dollar cost averaging, why don't you dump the stock and short it and make money as it goes down?
Well, that's what we know, and that's what we're hopefully people are getting excited, especially if you're new out there. You know, we got an eclectic mix in our audience. If you're an experienced trader, you know, we're going to get into other stuff too. If you're a new trader, just get excited about the learning process. You know, try to challenge yourself to do what Matt said there. Call your mutual fund and ask them, why didn't I perform as well as the market last year? You know, I want to hear their answer. I think that's a great homework challenge, Matt. And, you know, this is why we're here doing a podcast.
Yep.
You got my drop?
Well, you know, it is why we're doing the podcast. We want to educate the masses. We want to give people an opportunity to succeed in any marketplace because those opportunities were given to us. So, all right. Final thoughts, Tim, before I drop your end music.
Chicago Bears are a good Super Bowl bet.
What's Vegas odds?
I don't know.
21?
I haven't bet on a sports thing for so long. It's probably pretty low, but, I mean, they're projected to be pretty good, too.
I like the Bears this year. I think Cutler's going to have a fantastic year. Alshon Jeffries and Marshall, you know, he's not the head case that he once was with Denver and Miami. I like the Bears this year. You know, if their defense can perform and Jay Cutler, you know, doesn't lose his mind in the last 2 minutes of a game, you know, I think they're going to be. Right there with the Packers next year. You know, coming out of the
Chicago Bears. Hold on a second. Okay. 22-1.
I said 21 off my head. 21. There you go.
Denver's 6-1. They're the highest. Seattle's 13-2.
Right under Denver.
San Francisco, New England, Green Bay, New Orleans are right there. The Colts.
Who's in the 20-1 areas with Chicago?
Pittsburgh's 22-1.
I like Pitt's off season, but I don't think that's a little high for me. I like Pitt's off season, but that's a little high for me.
Yeah, Philly is 28-1, Cincinnati 35-1. Then you got a bunch of everybody.
Where's Miami?
Miami is 65-1.
That's a guaranteed $6,500 on a $100 bet right there. Guaranteed.
Lock it in, huh?
All you got to do is just think about it. On those same odds, all you have to do is have Miami win 1 year in the next 65 to break even.
Yeah.
That sounds like about the same odds as a 401k having you retire.
Right. So when this says odds to win the 2015 Super Bowl, that's for this season, right? So I'm reading the right odds.
Yeah.
Got it. All right. Dude, the Bears are like, if I'm reading this right, Vegas got some ranked about 9.
I'd say that's about accurate. I think they're a playoff team next year. I think they're going to do some damage. You know.
Don't get my... They'll break my heart again. You watch.
I don't even want to hear it. Try being a Dolphin fan since '84. Seriously.
All right,
everybody. Later on, next time, remember 2 podcasts tomorrow night. We have the real estate one. We have the economic one tomorrow, so look forward to those. And hit us up on Facebook, Trading Justice Facebook page. Check us out at www.tradingjustice.com. And also, as always, if you guys, seriously, you like the podcast, you enjoy listening to it, leave us a review on iTunes, at Trading Justice on iTunes. Give us a nice little 5-star ranking, and we'll keep on bringing the heat each and every week, trying to help you guys change your lives. Thanks, everybody.
You've been listening to the Trading Justice Podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice Podcast is proudly sponsored by TackleTrading.com. Get off the sidelines and get in the game.